There is a number that changes everything about how investing feels. It is not $1 million. It is not $500,000. It is $100,000. And today, we are talking about what actually shifts when you cross it, because most people have no idea what is coming. I'm Max of Monkey Money, and the $100,000 milestone is talked about a lot in personal finance circle, usually in vague terms like the first 100,000 is the hardest. What does not get explained is the specific mechanical and psychological changes that happen at that threshold, and why they make everything that comes next genuinely different. Let us start with the math, because this is the foundation of everything else. When your invested portfolio is at $5,000 or $10,000, your personal contributions are the dominant force in your wealth growth. Every month, whether you deposit $500 or $1,000, that deposit represents a significant percentage of your total account value, and the market return on such a small base is almost imperceptible. At $100,000 invested at a historical average market return of 7% annually, your portfolio generates approximately $7,000 per year in growth. That is roughly $583 per month in passive returns before you add a single dollar of new contribution. For someone contributing $500 per month, that means the market is now matching or exceeding their personal savings effort. At a 10% return year, closer to the S&P 500 nominal historical average, $100,000 generates $10,000 in a single year. That is $833 per month in growth, produced entirely without your labor. The portfolio has crossed the line from something you are building to something that is building itself. To put a longer-term lens on this, at $500,000 invested at 7%, your portfolio generates approximately $35,000 per year in passive growth. That is more than many Americans earn an annual salary. The compounding engine doesn't just maintain pace with your contributions, it eventually dwarfs them by a margin that changes what retirement actually looks like. This is the mathematical definition of the momentum shift. Below $100,000, you are the primary engine of growth. Above it, compound interest begins to share the load, and over time, it takes over entirely. Here is the number that makes this concrete. Getting from $0 to $100,000, contributing $1,000 per month into a portfolio, earning 7% annually, takes approximately 7 years and 3 months. Getting from $100,000 to $200,000 with the same $1,000 per month and the same 7% return takes approximately 4 years and 3 months. Same contributions, same market, 3 fewer years. The difference is compound interest operating on a larger base. At $200,000, the annual return contribution at 7% is approximately $14,000. Meaning the market is adding more than a full year of your personal contributions every single year. By the time you reach $300,000, the 7% annual return produces $21,000 of passive growth. Your $1,000 monthly contribution is $12,000 per year. The market is now contributing $9,000 more per year than you are, and that gap widens with every passing year. This is why the $100,000 milestone matters. It is not just a psychological victory, it is the threshold where the nature of your wealth building changes. You move from someone who is saving their way to wealth to someone whose money is doing the heavy lifting. Here is an analogy that captures what this transition actually feels like. Imagine spending years pushing a very heavy cart uphill by yourself. Every inch forward is entirely your effort, and stopping means rolling backward. At $100,000, someone hands you a motor. You still steer, you still show up, but you are no longer the only thing making the cart move. The psychological shift at this milestone is real, and it is different from any other savings milestone you will hit. Reaching $20,000 feels like survival mode ending. Reaching $50,000 feels like real progress. Reaching $100,000 feels like the game itself has changed. Below this number, most investors are focused on the saving behavior, cutting expenses, increasing income, maximizing contributions. The portfolio balance is something you watch grow slowly, and every market dip feels like a significant setback because it can erase months of contributions. Above $100,000, the frame shifts from saving to managing growth. A 10% market correction on a $10,000 portfolio costs you $1,000. The same 10% correction on $100,000 costs you $10,000. The stakes are higher numerically, but paradoxically, most investors report feeling more calm at this stage because they finally understand that market volatility is not a threat to their long-term outcome. It is the price of admission for the returns that make the whole thing work. The academic research on this phenomenon is called loss aversion. Humans feel the pain of a loss roughly 2 times more intensely than they feel the pleasure of an equivalent gain. At small account sizes, loss aversion is mostly annoying. At $100,000, it can trigger decisions that permanently damage your long-term returns if you are not aware of it and prepared for it. Knowing it exists by name and knowing it will show up when the market drops is one of the most practically useful things you can do to protect your outcome at this milestone. There is also a confidence shift that happens. At small portfolio sizes, every financial decision feels high stakes because a mistake represents a large percentage of your total accumulated wealth. At $100,000, you have enough accumulated evidence that the strategy works, that the boring, consistent index fund approach actually produces results, that the doubt starts to quiet. This confidence shift is not complacency. It is the earned conviction that comes from years of doing the right thing and watching it compound. It changes how you respond to bad market news, to financial media panic, and to the advice of friends who are convinced they have found a better approach. You have a track record now. That is worth more than any tip. Now, here's the part that gets skipped in most $100,000 milestone content. Crossing this threshold is not just a reason to celebrate. It is a trigger for a specific set of adjustments that most investors delay too long. The first and most important is the tax conversation. At small portfolio sizes, taxes on investment growth are largely theoretical. At $100,000 generating $7,000 to $10,000 in annual returns, taxes become one of your largest ongoing investment expenses, and how you manage them determines a significant portion of your long-term outcome. This is the point where the difference between tax-advantaged accounts and taxable accounts starts to matter in real dollar terms. If you have not already maxed out your 401k, your Roth IRA, and your HSA, $100,000 is the milestone that makes the opportunity cost of not doing so undeniable. At 7% annual growth, the tax drag on returns in a taxable account versus a tax-advantaged account compounds into tens of thousands of dollars over a 20 to 30-year horizon. Getting money into the right accounts is not a small detail at this stage. It is a major determinant of your final outcome. The second adjustment is around Roth conversions. If your portfolio is sitting primarily in traditional pre-tax accounts, a 401k, or traditional IRA, the $100,000 milestone is often the right time to start evaluating a Roth conversion strategy. Converting in years when your income is lower or in amounts that keep you below a higher tax bracket can permanently reduce the tax burden on your future withdrawals. If you've made it this far, hit that like and subscribe buttons. It really helps us keep making content like this. Now let us talk about the mistakes that derail people right at this stage. The $100,000 milestone brings a specific temptation that ruins a surprising number of investors who got here the right way. It is the urge to get more sophisticated. After years of boring, consistent index fund investing, the portfolio finally feels large enough to justify a more active approach. So people start tinkering. They add individual stocks. They try sector rotation. They start watching their portfolio daily and making adjustments based on what the market is doing. Every one of these behaviors has been documented to reduce long-term returns. Not because the strategies are necessarily wrong in theory, but because execution is expensive. Active trading generates taxable events. Frequent strategy changes mean buying high and selling low during periods of volatility. And the research on investor behavior is consistent across every time period. The more frequently investors trade, the worse their outcomes relative to simply staying invested in a diversified index fund. The $100,000 milestone is not the point where you need a more sophisticated strategy. It is the point where you need to protect the strategy that got you here. The boring approach did not stop working. You just reached the point where you can finally see it working. And the temptation to improve it is actually a threat to it. This is genuinely one of the more counterintuitive things about hitting $100,000. You worked for years to build an account that feels important enough to manage actively. And then the right move is to manage it almost exactly the same way you did when it was small. Because a monkey who spent 6 years patiently accumulating the best banana pile in the jungle should probably not start experimenting with unfamiliar trees just because the pile finally looks impressive. The most important thing you can do at the $100,000 milestone is also the simplest: stay invested. This sounds obvious. It is surprisingly hard for people to execute because $100,000 is the first number that feels like something real to lose. When the market drops 15% and your account falls from $100,000 to $85,000, the loss is $15,000. That is real money. It does not feel like an abstraction anymore. And for investors who have not experienced a significant correction with meaningful capital at stake, the emotional response can trigger exactly the behavior that destroys long-term returns: selling to stop the bleeding. The research on this is unambiguous. Investors who stayed fully invested through the 2008 crash, the 2020 COVID drop, and every other significant correction in market history dramatically outperformed those who moved to cash. Not because the timing was wrong in theory, but because nobody rings a bell when the bottom is in, and the best market recovery days are concentrated immediately after the worst drops. One practical way to manage this: stop checking your portfolio as frequently. Daily checking at $100,000 adds emotional exposure without any informational value. The portfolio does not need your attention every day. What it needs is your inaction on bad days, and the less frequently you look, the less likely you are to act on an emotion that the data says you should ignore. At $100,000, your primary job is not to optimize your portfolio. It is to not make a catastrophic mistake. Here is what the journey to your second $100,000 actually looks like if you execute correctly. You keep contributing consistently, you maintain your asset allocation, you resist the urge to get clever, and you let the existing capital keep compounding. The combination of your monthly contributions and the compounding on your existing $100,000 means you are adding significantly more to your portfolio per year than you were in the early years. Year one passed $100,000 with $1,000 in monthly contributions and a 7% return adds approximately $19,000 to your portfolio. By comparison, year one from zero added approximately $12,400 under the same conditions. That gap widens every year as the portfolio grows. The second $100,000 comes in roughly 4 years instead of 7. The third $100,000 comes in roughly 3 years after that. Each milestone arrives faster because the base is larger and the compounding is working on more capital. The patience required in the early years was not wasted. It was building the foundation for an acceleration that most people do not believe is real until they are living it. This is why the $100,000 milestone is genuinely different from any number before it. The first $100,000 tests your patience, your consistency, and your willingness to stay boring when boring is hard. The second $100,000 is the reward for passing that test. Not because the market becomes more generous, but because the math of compounding is now working at a scale where you can actually feel it. What changes after $100,000 is not the strategy. It is not your contribution amount or your investment selection or any tactical decision. What changes is the relationship between your effort and your outcome. And for the first time, the outcome starts to outrun the effort. If this video helped you understand what is waiting on the other side of this milestone, hit subscribe, drop a comment, and tell me, are you on your way to $100,000 or have you already crossed it?